All right, we're back. Time now to answer some of your questions. Stephanie Link, I'm going to start with you today from Dave in Alberta, Canada. What's your advice for retirement-aged investors?
Well, it would certainly start with being diversified, also very high quality, good balance sheets, blue chip companies, and income. Looking for income. It's very hard, obviously, in the bond market to find that. So I think dividend growth on the equity side, you certainly want to have big exposure there.
Josh Brown, Sam in London, what's the difference between investing and betting?
I think it's very straightforward. When you're investing, you're actually paying attention to the business as though you're a part owner, which in effect you are. So you care about valuation and the forward-looking prospects of what you're investing in. When you're a gambler or a speculator, you're more concerned with what other people's perceptions will be, and then trying to either get in ahead of time or get out before other people figure out what you figured out. So I think part of it is time frame and part of it is mentality.
Well, I mean, right, investing just says time frame, longer time frame, right? Now, day trading.
Right. If you're gambling, you don't care. If you're gambling, you don't care about the prospects of the company. You care about the other people's perception of those prospects and whether or not you think they will be bullish or bearish so that you can exploit that either with a buy or a sell. It's just a different, neither is better or worse than the other. It's just a different mentality, a different way to be involved in the market.
Pete, to you from Bill in Atlanta, Georgia, what do you think about buying long-term options, leaps, so-called leaps in financials and like the banks?
You know, the one issue I have with that, Scott, is when you buy out in time like that, when you're going for leaps and you're going at 6 months, 8 months, a year and a half, whatever it might be, you are paying for that time. And that sounds great on the outset. He's like, well, I'm buying the time. I'll tell you what, that can cost a lot of money. And I think when you, in between, you might miss the move. So I don't do a whole lot with leaps, quite frankly, Scott, whether I'm buying, selling. I like to get a lot closer, shorter term. 3 months out, 4 months out, that's about as far out as I'd like to go. But leaps, they're a great tool, but the problem is you are paying a lot for the time.
Okay. Rob Sechin, to you from Avi in New York. What about the idea of investing in special purpose acquisition companies?
You know, I would say this. Deal flow certainly came in the first half of the year, and a lot of people suspect that there's going to be an uptick in deal flow in the second half of the year. But what I think it leads you to is investing in lower quality companies with highly levered balance sheets. And I would say unless you suspect that we're going to see this economic rebound, it's probably too early to think about investing in that strategy.